from, I see Todd has joined us this morning with Bruce's departure as as a full board member. Todd, as the alternate, will be serving in a voting member today, but really serving as the fill-in for Bruce, and it's the VSEA bylaws that will allows the board to the VSEA board to nominate a alternate until the next election. So just for folks' awareness on that. So with that, I will call the February meeting of the Vermont State Employees Retirement System to order here at 9:05 this morning. First up on our agenda is approval of the agenda itself.
I'll move approval, Eric.
Thank you, Jay. Is there a second?
I'll second.
I heard Beth say she was second. Beth
Okay.
T.
Thank you, Betsy. I didn't hear that on mine, and I appreciate that. So with that, the motion is on the floor to approve this month's agenda. All those in favor of approval, please signify with an aye.
Aye.
Aye. All those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it, and this month's agenda is approved. Next up is approval of the minutes from our last meeting, the January 2025 meeting.
I'll move approval, Eric.
Thank you. Thank you, Jay. Those are in our board packet. Is there a second to Jay's motion?
I'll second.
Thank you, Betsy. With that, the motion is on the floor. Any discussion on the minutes? Seeing none, all those in favor of approval of the minutes, please signify with an aye.
Aye.
Aye. All those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it, and the minutes from our January 2025 meeting are approved. Next up on our agenda here, and getting right back on schedule, set for 9:07, is public comments. I'm looking around the attendees this morning. I'll just put a call out if there are any members of the public that have joined us this morning and would like to make any comments as part of the record of this month's meeting. Please signify with a hand raised or just unmute, and we'll recognize you. And this is the time for any comments from members of the public. I'm not sure who the 516 number is, but I'm not seeing anyone raise their hands. So I'm just going to give it another minute here. Make sure I'm catching any. No, I think. Okay. So not seeing any takers on public comments. I think we can move ahead to the 457 quarterly plan review. First up is Empower. I'm sure Gabe will lead us on that. But Tim, did you want to say anything, or just shall we hand it over to Empower?
No, I think we can hand it over to Empower, and then we'll move into the investment review with RVK. I've included the IPS watch list review as a separate agenda item, but those will really be brief and wrapped into the overall discussion with with that Sarah is going to lead. And just wanted to note them as an agenda item because we want to get in the annual habit of just taking a look at them. This time, obviously, will be brief, having just addressed them. So that's what to look for in the first hour.
I appreciate that, Tim. Thank you. So with that, Gabe, the floor is yours.
Thank you, Eric, Mr. Chairman. Appreciate it. And a very good morning to all of you. Wonderful to see
Morning,
many of you
Gabe.
again. Good morning, Jay. First and foremost, Happy New Year, everyone. It's been a while. Hope you're all keeping warm up there. It is starting to warm up a little bit here. So I'm going to do something just a little different this go around. I have the ability now of using chat internally here at Empower. And I did a comparison of a year over year. So I'm going to provide you with some statistics. You don't have to write them down. But I'm just going to provide you with some high-level comparison statistics. And going forward, I'm going to include this one pager that I have with future reports and have the reports underneath. Following this quick overview, I'm going to just touch on my report, which I will share. But I just want to touch to cash flow and distribution and investment strategy. So there's a lot of data behind the scenes for your reference. So I thought I'd do that. And of course, I want to thank my Empower team. We've got Ryan, Scott, our communication strategist, and welcome to RVK. And I see Chip as well, who Chip and Nick will provide a field report as soon as I get through some of this. If I go too fast, please slow me down. But I just want to keep within the allotted time light. So year-end results. Let's look at we're talking about the deferred compensation plan. From full year results from 2024 to the end of December 31st of 2025, the plan growth and scale. Plan participant assets have increased by about $80.5 million. It's about an 11% increase from $732.4 million to $812 million as of the end of the year. Pause for 2 seconds to say, as of yesterday's close, it's up another $20 million. We're at $832.3 million as of yesterday's close. Participants with a balance grew by 270, about 2.9%. For participants went from 9,281 to 9,551. Participant outcomes, the average account balance increased by 9% from $78,800 to $85,000, outpacing inflation and improving individual retirement readiness. The median lifetime score, and again, a lot of this information is in the presentation, which looks at your income replacement ratios, went from 54% the plan median to 60%, with the plan average rising from 64 to 73%, again, reflecting improved savings behavior, asset growth, and investment positioning across the database. Retirement readiness, again, participants, their retirement goal increased from 10 to 17%. Contributions and cash flow, total contributions year over year increased, rose to 37 million, I should say, up from 32 million, so up about 17%. Net cash flow remained negative due to expected distributions, but asset growth was much more sufficient to offset some of the outflows, resulting in the higher ending balances. And then investment and engagement trends, right? The use of diversified investment strategies continue to be strong. Continued growth in target date funds, asset allocation models, goal maker, and a slight decline in the pure do-it-yourselfers, which is starting to gain traction in the guided solutions that's available to them. And then goal maker participation is now at 2,750, rising to about $145 million, reinforcing the age appropriate of diversification. So the bottom line for the year 25, it was a very strong year for the plan. Higher assets, improved participant balances, meaningful gains in retirement readiness, and the year-over-year improvements suggest that the plan is effectively supporting participants, translating to savings and investment behaviors for better long-term retirement outcomes. So really, really good year-over-year results. And now, before I go into the presentation, any questions before I launch my presentation here? Apologize for the sore throat here. Can everyone see my deck here?
Yes.
Good, thank you.
Yes.
I'm just going to go to my view here, menu that's up here, and let's go to a full screen mode. Okay, hopefully everyone can see the full screen mode. Okay, so we're just going to go through a couple pages here real quickly. Again, as of December 31, 812.8 million, representing 9,500 accounts. And we saw the increase there, and we're at 832 as of yesterday. The average account balance is about 85,000, right? The benchmark is 82, as compared to Empower's government book of business, with the top being at 135,000. We're going to get into the investment strategy utilization, put some numbers by the different strategies. And then when you look at the allocations of all the asset classes, large cap funds continues to be the largest sector, if you will, section of about 35% of the total assets. Again, lifetime income score I touched on. Let's look at money that came into the plan. 37.4 million came into the plan for the full year. 62 million went out in distributions. Net negative cash flow of $24.5 million. And again, we're providing you with a quarter over quarter breakdown of the various ins and outs and flows. The line I want to point your attention to, and I know Sarah will speak to this, her and her team, but the change in value line down here. This is the market valuation. So as you can see, first quarter of 25, I'll say, right? Down 4. But look at the pop in the market the last 3 quarters. 53 million, 41 million, another almost $16 million in market appreciation. So again, when the markets appreciate and participants are diversified, they are the winners here. They are the winners here. Of that $37 million that came in the door, broken down as follows: 26 is before tax deferrals, 7 million of Roth, and then the other of almost $4 million, 3.9, those are rollovers into the plan. So when people are meeting with Nick and Chip and Brian and they say, hey, I'm either joining the plan or I have outside assets, they're rolling those monies into the plan. And that's always a good thing to view their account from a holistic basis. And then you'll see here the rolling 12-month period, if you will. So looking at a run rate of contributions, 2, 3, let's call it just under $3 million. Let's just call it under $3 million in terms of money coming into the plan. And then allocations. Now let's look at, okay, so we know 37 came in, and as I said, we're in negative cash flow. What made up the 62 million that left? The majority of that 62 million, or $51 million, is what's called separation from service, 3,380 accounts. Now, separation from service comes down to 2 types of transactions. First is individuals that simply leave and roll their money out to another plan or to another financial institution when they retire. And we see a lot. It's very, very common for plans that when they become mature, people like to, put all their monies together. They do know that they can keep it here, and many do keep it here, which is a goal, obviously, keep money in the plan. But there are people that like to, lump their accounts in other places and move them, do their own financial planning, which is permissible and fine with that. The other component is people that are in the plan and are retired, but are taking installment payments. They may, give me $5,000 a month until I change it or until my account, liquidates, etc. So we've got installment payments, ongoing installment payments, as well as individuals that have separated from service. In addition to that, there are required minimum distribution payments. So there were 700 of those last year, representing almost $5 million. And remember, that's now scaled. So required minimum distribution, I think, is now moved to 73, if I'm correct, Chip. Keep me honest here. So again, what is required minimum distribution? This is when the IRS says, when you hit a certain age, you need to now start taking money out because they want to tax you for that, right? They need to collect their pound of flesh that you've been deferring your entire career. There were some in-service distributions, hardships, again, they speak for themselves, qualified domestic relation orders. And sadly, over the year, there were $2.8 million in total death distributions. So we saw money coming in, and now we're looking at money going out. Run rate, it varies, probably $4 million. Somewhere in there, maybe 5 at times. You can do that average, and I'll leave it out there as well. So the plan is doing exactly what it's intended to do in terms of that. The next page is, I want to go to page 12 here. Again, I talked about the investment strategy utilization, and we kind of break down all the various components here, right? So we've got 700 participants approximately and $45 million representing my total retirement. This is the paid for service that participants have to acknowledge and say, yes, I want my account professionally managed, and there's a fee with that, and they pay that fee. 47 participants utilize what's called the online advice, which is free. It's basically a static snapshot to give you a recommendation. Your target date strategies, 2,100, 83 million. Asset allocation is your goal maker asset allocation tool, and that's been in play now for quite a bit now, maybe 7, 8 years. Again, 2,750 participants representing 145 million. And then the balance of that, as you can see, the individuals, or 40% of those individuals, are 3,800, which do their own asset allocation. They invest the money the way they deem appropriate. It could be in a combination of all this, or they just do their own thing, and which is wonderful to do anyway. Bottom line here is we got really, really good diversification across all of the various strategies there that participants are taking advantage of and utilizing to help meet their financial needs. I'll say one comment about 457 plans that will be coming out in a white paper shortly. What we have seen here at Empower, and we're one of the second largest, but one of the largest governmental providers, more and more individuals are becoming more aggressive in their deferred comp plan in terms of asset allocation. That's a couple of reasons. One, they're becoming more financially literate. They're really taking an onus and learning about this. But second is they're using this money to be more aggressive because they have the benefit of a defined benefit plan. They have a safety net. So it's a lot different in the corporate environment when there is no defined benefit or pension plans, but state and local governments have that. And for a lot of people, that is their safety net. So whatever they contribute here, remember, this is voluntary money that they put in. This is now money that that not only they put in, but want to invest more aggressively to try to attain better outcomes. And it's interesting, as individuals get on in their tenure, they get a little older, depending on where they are, will also determine if they become a little more aggressive or a little less aggressive. It's a really fascinating thing to see over the last couple of years. And then we break it down for you. We have participants that are actively still working and those that are separated from service. Point here is when someone leaves service or separated, a lot of them still stay in the plan, still use the tools, and still stay actively engaged in their deferred compensation plan, which is a goal for many, many governmental plans. How do we keep money in the plan, right? Because there's a lot of benefits to that. So good to see that participants that are separated are still staying in plan and utilizing the various strategies. Now we're going to break down by specifics. So the investment strategies advisory services, as you can see, over the course of the year, it has grown from 450 to 700 participants, representing about 7%, 5.6% of the participant assets. And then we even give you demographic data, the age group, who's using what service, average account balance, et cetera. Again, a lot of data here for you to digest, but it's pretty much in line what we see with a lot of governmental plans. So advisory services, insights, et cetera, et cetera, et cetera. Then we go into GoalMaker with asset allocation. As you can see here, the assets have grown to 146 million, but participation has pretty much leveled out. And that's what we see with most plans. A lot of these strategies, based on the demographics and the population, a lot of them will pick a strategy and then just kind of stay that way. So we've been seeing this stabilize out. So again, we had about a 28%, 29% participation rate, about 18% of the assets, representing $145 million. Again, more demographic data. What, by age group, what strategies are they using? Are they conservative, moderate, or aggressive? So we give you, again, a lot of data. And then a snapshot of participants that are in GoalMaker versus non-GoalMaker. And then we roll it all up for you and saying, here are all your funds. And here's all the strategies and the assets invested in all those various strategies, okay? So a lot of data there for you as well. And then we go into just a snapshot of all your funds as of December 24 to December of 25. Those are the assets, et cetera. Additional insights by quarter. Again, more tenure. I'm going to close out with this before I go to Chip, and it's all about the Empower Communication Engine, which meets participants where they are. It's really, really designed. It's very intuitive, multi-channels, but it's personalized to individual activities based on what they do and how they do it. So looking at your population, again, we can look at your population, and then we look at your peers and et cetera. Those that get started, those that save and invest, planning and optimizing, just some statistics here. Again, how your plan compares. You know, for example, just on savings and investment, right? With the percentage enrolled in managed accounts, your plan is about 7%, your peers are at 9%, top peers are at 36%. Just different statistics and metrics for your reference in terms of how you compare to your peers and top peers in our book of business. And again, more participant activity. There's a lot of data here. Just a lot of data there that we like to share with you in terms of how your plan compares. Finally, before I go to Chip and take your questions, the single deposit account. Again, that's at a run rate of about $2 million. There's about $19.7 million in the SDIA account. We just like to report on this, about 600 people. It's the distributions, it's just distributions out. As you can see, no contributions in. And it continues to be what we refer to in the industry as a wasting trust. So just total disbursements for those individuals. And that's pretty much it. Now, I kind of went that through quickly because there was a lot to cover. Let me stop sharing for a moment. Are there any questions that I can address for you at the board? There's a lot of data, a lot of stuff there. But net as a report card, to me, A is a really good score here. All of the metrics seem to line up. Things are proceeding the way they are supposed to. And the engine behind that is investment performance that I know Sarah's going to get into really shortly. So any questions before I ask Chip and Nick to provide a field report?
Not seeing any.
Yes. Yes, Gabe, I do.
Oh, okay.
Feel
free,
Jay. You breeze through a lot of information. It's very interesting. It looks like for the most part our plan is very consistent with similar plans in your operation. But I wondered if that you noticed anything that's not expected or not the ordinary.
You're on mute, Gabe.
No, Jay, I've not. When I look at my portfolio, they're all humming in the same. Here's my observation, Jay, which is it's a fascinating question, and I've been looking at this a lot with all my clients.
Sure.
When markets are doing what they're doing, not only are people happy, but there's a lot of similar trends. When markets are going south and people are upset, the markets are doing the trends are similar as well, going down. So there's nothing that sticks out to say, or what's the learning, Gabe? If the markets go down, what should you be doing? What you should be doing is what a lot of financial experts will tell you. Stay the course, dollar cost average. Don't panic. Don't sell. The ones that don't sell on a down market and ride it out and stay within their objectives, if you will, and their risk tolerance, they come out smelling like a rose, to use the analogy. Sorry to say. That's what I've seen, and it works. If you're disciplined, it works. It does work. But sometimes there's pain along before the markets rise.
Sure.
So, but if there were, I would tell you, as my commitment is to share good practices, best practices, etc.
Yeah, wonderful. Thank you, Gabe.
Yeah, it is my pleasure. Thank you. Any other questions?
I have one more. A great question, Jay. So, Gabe, in your observation that really participants are using this to complement the defined benefit and taking on a little more risk. What are you seeing across those government plans that sort of signal that?
Just diversification. What we're looking at our book of business, right, especially in the government space, for those and it's for those that have a pension plan. This is a voluntary plan, and a lot of them are enrolling in the plan because their friends are doing it, and their friends tell them, and they meet with Chip, and people saying, how do I save money? They start with $20-25, and some are doing a lot more. Now catch up is whatever. So it's a combination of that. But to me, the biggest input there is participants have become more financially literate over the last 20 years. They're saying, I've got this benefit. I don't have to take it out when I leave it. I can legacy plan with it. I can buy a boat, a house, help the kids, whatever I want to do. This is their little icing on the cake, so to speak. So they're saying is, how do I maximize my return? And they're saying there's a lot of tools like target date funds and advice and things like that they say, I want to be more aggressive. So the needle is slowly trending up for those individuals becoming more aggressive. And as I said, what we're seeing, and there'll be a white paper on this shortly, what I'm seeing is as they get older, some have said, wow, I haven't saved enough. I need to be more aggressive, especially now when they see the markets doing what they're doing. That's it in a nutshell. And I'm sure Chip and Nick hear that a lot from people that they talk to.
Thank you. So it's really dialing up the aggressiveness.
Yeah.
I appreciate it.
Not everybody to the extreme, but
sure.
They have dialed it up. And that's contributing to some of this. Yeah, absolutely.
Thank you, Gabe.
Thank you for the questions. If there are any questions, please interrupt. So, Chip, take it away with the field report. You and Nick, please.
Good morning, everybody. A quick stat that I was thinking of as Gabe was talking about the change in the assets in 2025. The year I started doing this, when I stopped working in the retirement office, started doing this, was October of '02. And that year, the balance of the deferred comp plan was 80 million. The fact that it increased by 80 million in 2025 is just amazing to me. That's just an interesting stat from days gone by. So most of you know we added Nick in the last quarter. I promise to stop calling you new, Nick. You've been here for months. But I want to let everybody know he's fully up and running. Got all three of us out in the field, doing a lot more in the field than we had historically. Still doing the virtual appointments where it makes sense, but definitely nice to be back out where people are seeing us and saying, "Oh, you should go talk to Nick. You should." I've been meaning to increase my contribution. Good to see you. So we're seeing a lot of activity that way. Also, the last quarter of the year is a busy quarter for us as far as events. We did a lot with health fairs. I made some notes. VTrans trainings throughout the entire state. Pre-retirement seminars with the retirement office. The City of Rutland Benefits Fair, for example, it falls into that quarter. Still doing corrections, new hire meetings, and the same with Vermont State Police. So a lot of that activity all comes into that one quarter where we are spending a lot of time doing things like that, which worked out great with Nick to be able to hear all the crazy questions we might get for something. It's perfect timing. So in addition to that, Nick's actually working with HR right now, helping with a presentation on financial planning or financial wellness, I guess it is, Nick, so that they can co-present something for the state coming up here soon. A lot of things like that. The biggest thing is being back in front of people as much as it's been years since we've had this much activity face to face, and it's fantastic to be able to be doing that again. And word is getting out. People really like the retirement readiness reviews that we're doing with them, where we do a deeper dive. We look at things like the pension, Social Security, a spouse and their income and things like that, and help people really drill down. This is where I am. This is where I want to be, and this is what I need to do to get from here to there. Taking a deeper dive than we've been able to do before. Words getting around when we go to places. I just went to, I'm just coming back from being out with the flu, but I have scheduled, and one email went out to one section of the National Life building, and it booked, I think I'm up to 9 days now. But it started at 6. But as you do these appointments and word gets back, people go back to the office and they're talking about it. More and more people are jumping on and wanting these appointments. So they're very popular. We're seeing a lot of people making positive changes. Not hearing anything, like everybody's retiring or anything like that. I haven't been hearing that. Hearing more, just people are planning. People are trying to make sure they're invested properly and they're saving enough to get where they want to be. So things are chugging along, going well. Any questions on anything about the field? Fantastic. Back to you, Gabe.
Thank you, Chip. Well, on behalf of all of us, the entire team and Ryan and everyone and Scott, thank you for the opportunity to serve you, continue to serve your participants and your retirees. We very much appreciate your partnership in the business. Working along with staff, I have to give staff a shout out, Bill and team staff, and also with RVK. It's a wonderful partnership. So we're excited about what the future brings. So with that, Mr. Chairman, I'll bring it back to you with just a thank you from all of us.
Okay. That goes both ways. Thank you, Gabe. Thank you, team. Thank you to Empower. We appreciate the all work you do to administer the system. So it's definitely, the feeling's mutual.
Thank you. Thank you.
With that, I think, we'll hear from RVK, on the 457 as well. Go turn it over to Sarah, I believe, who will be leading us on this discussion.
Good morning, everyone. Great
Morning.
seeing you all today. I'll be sharing materials as well. All right, so we have a full agenda for you today. So to make sure we have enough time for your feedback or questions, and I'll keep my comments higher level. And as you've good at doing, please stop me at any time and let me know what areas you would like to explore or discuss further. So I'll start with the quarterly investment update, and then we actually have our first quarterly watch list policy update for you today. With the adoption of the watch list policy back in October, RVK and staff shared with you all our recommendation for watch list manager placement at the November meeting. And what we're doing today is we're bringing you all our first watch list update, which is we're not bringing today any recommendations at this time or any board action as a result, but we wanted to, on a quarterly basis, what we'll be doing is to share with you any important manager updates and our perspective and thoughts on those managers based on changes we've observed over the prior quarter. We also have on the agenda for you today the fee structure review and recommendation. After all the great feedback you gave us, we reached a good list of finalists, alternatives that we discussed at the January meeting. And staff and RVK since then have been exploring alternative paths forward and discussing implementation with Empower. So today we're ready to bring to you all our recommendation for a new fee structure to potentially be implemented in the third quarter. And finally, as Tim mentioned earlier, we also have on the agenda our first annual IPS policy review. It's not a separate item in the agenda for you today, but we listed it here. And the reason it's not a separate agenda item is since we've just approved the investment policy statement a few months ago, we don't have any recommended changes at this time. But we do think it's best practice to still review it on an annual basis, and we'd like to do that in the first quarter of each year. So let's talk a bit about this shortly, but going forward, we do expect to have potentially some recommendation based on best practices or anything that we may have seen changed in the regulatory environment. And we encourage you all, of course, to also take a look at the policies for the 457 and SDIE, and let us know if you have any thoughts or feedback or a new perspective since the last time we looked at it. So I'll start with the investment update, but before we jump into the plan update itself, maybe I'll just spend a couple of minutes just unpacking what's been happening in 25 and what we're looking forward to in 2026. Very briefly, it's worth, I guess, remembering how eventful 2025 was, especially when you look at this page. You wouldn't really think that 25 was a volatile year where we had a double-digit drawdown in markets in the second quarter. Just by looking at the performance here on this page. But there were also calls of recession, as you may recall, earlier in the year as a likely outcome at some point after the tariffs were rolled out. But looking at the year overall, we think everything has generally been very stable. Inflation continues to drift lower despite the new tariffs. The last official read we have is from December. For both headline and core, inflation came down from earlier in the year and are moving toward the Fed's comfort zone. The labor market has softened, but is still very, very healthy. Unemployment came in just slightly higher at 4.4%, but still below long-term averages. So the job market is certainly cooling, but it's not collapsing by any means. The growth story is also very good. We now expect the full year 2025 real GDP growth to come in at around 3%, in line with the 20-year average, historical average. So that's really a good number. We don't have Q4 yet, so that's still an estimate. And if you look at market performance at the bottom left hand side, you see equities, after some drama earlier in the first half of the year, equity markets deliver strong return for the full year, driven by US mega cap names delivering really strong results, but also international markets have done well, if not much better than the US, delivering returns of 34% for EM and 32% for developed non-US markets. And looking at 2026, we're seeing a continuation of some of those trends where emerging markets is up almost 9% as of end of January. Meanwhile, in the US, we're seeing some changes and some rotation within US equities where small cap has outperformed large cap in January. Value has outperformed growth. This is exactly the broadening investors have been waiting for, especially with valuations in technology being as stretched as they are now. So this has been really a welcome change. And there's hope in the markets that we continue to see this broadening out in performance across sectors, and that would certainly benefit a lot of your active managers that have a lot of exposure to valuable and high quality companies outside of that tiny, narrow sector of technology oriented companies. And
Sarah, can I interrupt?
Sure.
Question on the key economic indicators. I wonder what your thoughts are about the U.S. government debt, which is, that blue dot isn't where you'd like it to be.
Correct. Yeah, no, it is not where you would like it to be. And there is a lot of fear in bond markets. You can feel it certainly, and it has translated into bond market volatility in the last few years, and which impacted everything from the safest treasury bonds, which have seen volatility that we haven't seen ever in its record, or high quality bonds as well. We've seen a lot of market volatility there. There is a big recognition that U.S. government debt has to come down, but unfortunately, or at least in the near term, with the administration clearly signaling that their goal is to continue to push for additional fiscal stimulus, additional monetary easing. There isn't an expectation that government's tightening its belt, certainly in any meaningful way. What the administration is hoping for is that we will reduce this debt through growth. So as the economy grows more and strongly, and I think will basically inflate some of that debt away over time. And of course, that's a dangerous path, especially if it leads to runaway inflation or very, very high inflationary figures that are not easy to reverse. So it is something we're monitoring very closely, and we're happy to see that there is wide recognition that this is an important indicator for now. Thank you for raising that.
Yeah, thank you, sir.
Thanks. So speaking of bond market volatility, we don't have it in this book right now, but bond markets have certainly experienced a lot of volatility in 2025. But again, similar to equities, if you look at bond performance, you wouldn't have guessed that, where returns have been very solid in 25 overall across sectors. And per usual, we saw a slight outperformance by the lower grade, lower quality bonds relative to investment grade bonds last year. We're seeing a continuation of that trend in 26, and spreads are also very tight compared to history in that space. So that's also something we're monitoring, especially since, given the concerns we're hearing around credit markets and maybe some areas of pockets of higher default there or concerns. So overall, I think the bigger picture here is 25 was a year of resilience, and so far in 26 we're seeing a story of normalization in the economy and rotation within equity markets, positive growth, lower inflation, labor markets being steady. We are hoping that the rotation is going to be a constructive story, as I said, for your active managers and target date funds this year, and we're hoping that markets will continue to be resilient in face of maybe policy uncertainty this year. Any other comments or thoughts about markets before we jump into the plan update? All right. So we'll start with the single deposit investment account. As we do, he did a great job there. As he mentioned, assets and participants have been gradually declining over time. This account is fully invested in the state of Vermont Stable Value Fund. As you know, it's a multi-manager commingled fund. It's an institutional quality strategy. It's run by Mission Square. As you may recall, it's currently on watch, and we are going to spend a bit more time talking about it in a short bit. So I won't spend time on that now. Jumping to the 457 plan at the end of the year, assets were at 814 million, up from 806 in the prior quarter. Average balances, you can see here, have been steadily growing, both the average and the median balance, consistently each quarter. If you look at the bottom left chart, you can see, however, that with outflows surpassing inflows in every one of those 4 quarters, this growth in balance has been really driven by market gains, like Gabe has mentioned earlier. This is a mature plan. You can see here that terminated participants or separated individuals represent the bigger chunk of those older age cohorts, and those tend to have higher average balances than younger folks still joining the plan. So as you see more and more of those people leaving, you tend to see more outflows. So, continuing to communicate the value of the plan to participants is really important. The value of staying in invested, taking advantage of the due diligence and the high value, low fee institutional quality options that you offer to participants. When it comes to the investment menu usage overall, you offer participants 3 investment menu tiers. The do-it-for-me tier is for folks who like to invest in either an asset allocation fund or service that the state has vetted and selected on their behalf. You offer to participants the zero price target date funds as a default option, and you currently have 14% of assets, or about 23% of participants invested in that default option. Managed accounts currently hold around 7% or so of participants. That's slightly up from the last quarter, around 31 participants or more or so enrolled over the quarter. Goalmaker is also up slightly from 28.5% to almost 29%. 48 additional individuals enrolled over the quarter. In terms of, so in total, if you look at the three categories, in general, you have about 59% or so of all participants that are invested in the do-it-for-me category, which is pretty in line with similar public mature DC plans that we work with. What's different is in other public plans, we typically see higher usage of the default option, but a lot of people are using Goalmaker also as an alternative to that default in your case. For folks preferring to build their own portfolio, using options that the plan has selected on their behalf. You offer participants 18 core options. 41% of your participants are building their own portfolio using that core menu, which is pretty in line with peers as well. And a very small number of folks, 14 people, are in the self-directed brokerage account. Not unusual as well. I'll skip over those pages, but maybe just jumping to the manager monitoring dashboard. This summarizes key qualitative and quantitative indicators that we think are important to review each quarter, and we will be flagging any important changes that we see over the quarter. As you may recall, in the 457 plan, there has been fund changes that took place in Q4. 5 of the funds have moved to a lower fee share class. This impacted your Dodge & Cox International and Dodge & Cox Balanced Fund, the Impact Sustainable Allocation Fund, and the Calvert Bond Fund, and within the passive menu, the Vanguard Institutional Index Fund. You may see slightly different tickers there. That's because the share class change took place in October. While there aren't a lot of team and organizational changes that we saw over the quarter, we did flag a couple of changes here for you. As a reminder, we only note changes that we think could be possibly adverse changes that could impact long-term performance and that we think are worth monitoring. There are a lot of changes that are happening in any given quarter within teams and firms. We only flag ones that we think are significant. And the 2 updates we have for you today are on the organizational side. There has been a change within the Vermont Stable Value Fund. Their currently former CIO, Doug, who has recently departed. We just heard of this earlier this month, and was replaced by the current head of the firm's investment strategies. And they also hired a new head of fixed income. The now former CIO has been at the helm for less than 1 year at this point. So this is something that we think is worthwhile to note, given especially prior turnover we've seen at the firm and within their investment team more specifically. We'll talk a bit more about that during the watch list policy update. The other update we're flagging here for you is for the T. Rowe Price Stock Fund. This strategy just announced in the 4th quarter that they will be reopening and accepting new clients. It has been closed to new investments for an extended period of time. Their current AUM is 18 billion. So we view this as somewhat negative, as higher asset levels will push the manager up the market cap towards higher cap companies. So we are monitoring this going forward, and we're hoping to see no changes in their investment profile. We don't think it's significant enough to warrant watch list placement at this point, but it is something we just wanted to flag for you all. Otherwise, there has been no changes in manager ratings during the period, and many of the strategies continue. All the ratings, many of your studies continue to have positive rating. Fees are generally in line with peers, with the exception of the Vermont Stable Value Fund, which is currently ranking slightly higher than what we see with peers. And as you know, there are 3 strategies that are currently on watch, and then we'll discuss them more in a little bit with you all. When it comes to performance, the T. Rowe Price target date funds continue to rank well compared to peers over the long term. Their near-term performance in 25 was hurt by their bias towards U.S. equities, and as I mentioned earlier, non-U.S. equities outperformed in 25. But obviously, over the long term, if you look at how they compare to peers, Their glide path design has really has been additive overall and helped with their performance. And we're actually seeing more and more managers move in the direction of the zero price glide path design and the way they allocate across asset classes. Which a few years ago, that design was a bit more unique. Now it's more common to see managers having similar allocations across the target date funds. Passive managers also did really well. They continue to track their benchmarks within a reasonable tracking error. Vanguard FTSE Social Index, we spoke about this before. They actually track the benchmark well as also, but their fees are slightly higher than the average peer in that peer group, and that actually pushed their excess return figures slightly outside of our expected range of 10 basis points, so only minor. So no concerns with them as well. Within active managers, with a couple of exceptions, all managers have really performed in line with expectations. There are pockets like US growth. Most of your Vanguard US growth and Zero small cap have a growth bias. And pockets like US growth are areas where active management has struggled in recent years. So even though they have both underperformed their benchmark, they have actually done well compared to peers over longer trailing periods, like if you look at the 7 and 10-year performance also. And then the two sustainable funds you have on the menu that are actively managed are both managed by Impacts. And they have both had performance challenges over compared to benchmark and peers over the 3 and 5 trading periods that we're showing here. The Impacts Global Environmental Market Institutional, which is a global equity manager, is currently on watch, so we'll talk about them a bit more later. The other strategy is not on watch, and we spoke to our manager research team, and they feel that while we're gonna monitor them closely, they're actually performed well over long term. They outperformed the benchmark and peers in 7 out of the last 10 years. So even though this looks bad, this is mostly driven by recent performance. And as we talk about this before, thematic managers, sustainable managers have really underperformed and struggled in 24 and 25. So no concerns with them at this time, and we don't feel the need to put them on watch. Generally speaking, with a couple of exceptions that we'll touch on later, all your managers are performing in line with expectations, and we don't see any immediate absence. So with that, there are no questions about the managers. Maybe I'll touch on cash flows, and then I'll wrap my plan update. Overall, aggregate cash flows over the quarter has been in line with prior quarters, more distributions and contributions, really happening across asset classes, and a bit more in absolute terms of asset, which makes sense given there are more assets in the field.
Hey, Sarah, I'm sorry to interrupt, but your vocals are getting a little choppy. I wonder if you might turn off video, and that could help.
Yeah, thanks, Tim. Is that better now? I turned off my video.
Yeah.
Okay. Thank you. Thanks, Tim. So, all right, I'll keep going. That concludes all my remarks on the performance report. Any comments or questions before we turn to our next agenda item? There are a lot more good stuff here that we're recommended to take a look at, and let us know if there are any questions. But before we jump into the watch list, I believe the next agenda item on your side is the investment policy update. So as I mentioned earlier, this is as a best practice to make sure policies continue to align with new developments. This is something that we'll be doing every year, taking a fresh look and coming to you with any recommendations for incremental changes. Just wanted to say that we encourage you all to do the same. This is your and our handbook for plan oversight, and hopefully will serve as reference for us all in monitoring the plans. And it's what helps us create this periodic review cadence for managers and service providers, and reviewing the IPS itself also is part of that policy guidance as well. And the goal here is to make sure participants are getting this consistent diligence and oversight. So while we don't have any changes for you all today, this is something we felt is important to have on the agenda at least once a year, and encourage you all to take a look at that as well. The next agenda item is watch list review. This is
Sorry,
our
can I
first.
pause?
Of course.
Can I pause you there? Sorry, I was struggling to find the unmute button between two screens. So just on that agenda item, the investment policy statement, this is something that we adopted also not too long ago. Could you just remind me of the timeline on that? I'm just trying to think about the right cadence to be taking a look at all that. Maybe Tim, maybe you could help out with that too.
Yes. No, it was, so the investment policy statement and watch list course, I believe, were adopted in October. So that is, that's last quarter.
Excellent. Thank you. That addresses it for me. Appreciate it.
Yeah, and just going forward, Eric, I think a big reason why we have it on the agenda is I'd like to kind of use this time as the annual review time. So, it's pretty soon after adoption. That's why it's an abbreviated presentation here. But on this, around this time next year, we'll come back and then just get in that habit. So we figured we'd put it on the calendar for this year.
Got it. So this sort of establishes the review, we would expect it this quarter, annually from here on.
Exactly.
Excellent.
Yeah.
Thank you. Appreciate it.
So, and actually this newly established investment policy has also established for us this watch list policy structure and cadence of review. And in accordance with the investment policy statement and watch list policy addendum that came with it, we will be presenting you all with a quarterly update on your watch list managers, and the cadence for that is within a 90-day period. RVK and staff will come to you all with thoughts on potential next steps for managers, and that could include anything from, we think a change might make sense, but it could also be that while we're seeing improvements and things are heading in the right direction, we still think that keeping them on watch does continue to make sense for some time. So all it does, the goal of the watch list policy is just to make sure we all stay on top of managers, getting regular updates, creating a structure for monitoring them, and that we are watching for any signs of changes that may warrant future escalation, so we don't have to make any major changes to your investment menu. And just a quick reminder, the way we created the watch list policy, it doesn't automatically imply that this is a manager where we are seeing big red flags and we think they're likely to get fired. In fact, more often than not, managers that end up on the watch list also end up then coming off watch within the recommended period with no recommended changes. All it means that we're just increasing the oversight because we saw something that changed that could be meaningful and that we think warrants further review and maybe a heightened level of oversight. So with that, currently we have 3 managers that are on watch. The first one is the Vanguard US Growth Fund. this is a large cap growth strategy. It has significant assets. It's popular within DC plans. It focuses on long-term capital appreciation through investing in managers with strong growth expectations. It's bottom up. It's managed by multiple sub underlying advisors, Wellington, Bailey Gifford, and Jennison Associates. And each of them employs a complementary style, and it has really done well relative to peers over the long term, despite some short-term hiccups, especially in particular in 2022, where they have significantly underperformed. But if you look at their track record over longer time periods, they've actually done well. And we don't have any performance concerns with them at this time. It has been challenging in general for active managers to outperform the Russell Growth Index, given what I described earlier, the narrow focus of the index performance, the concentration of performance in a handful of mega cap names. So that is not really our concern. The placement was not driven by that. It was driven by the changes that we've seen within the team. We think that change will warrant additional monitoring. So two of their underlying advisors had announced manager transitions very recently. Wellington Management had their lead manager, Andrew Schilling, retire in December of last year. And then on the Jennison side, we also saw the retirement of one of their managers, Kathleen, but it's a multi-manager structure, and her responsibilities transitioned to someone else on the PM team. Given that these are two core players within their own respective teams, we felt it's important to monitor their long-term results, make sure that it continues to be consistent with expectations for this specific strategy, and that there are no changes in performance results or in the strategy objectives after the succession period, and no changing processes, etc. So that is why this manager is on watch, and we don't have any recommended changes at this time. Any questions about Vanguard? The next one, we talked a bit about it already, is the impact strategy. This is a global strategy, and it's rare to find sustainable strategies within this space of global equity. So it's a very small universe, and it's a bottom-up strategy. Also means that they pick managers, they select in specific companies, and they put them in their portfolio. And they are not very benchmark aware, so they may significantly overweight certain sectors relative to the benchmark, and their performance can be volatile. You can see 2020 and 21, they significantly outperformed, but then for the next 4 years, they underperformed by a significant amount. So tracking error is not an issue. Our concern with this strategy has been the fact that they have underperformed for multiple years, and when our manager research spoke with them, they did confirm that they will be making some adjustments to their portfolio to take a more defensive stance, and this may not necessarily lead to outperformance in periods where markets are going up significantly or are driven by growth, but it will help their long-term performance during periods of drawdown, and hopefully, as we see rotations within the market, like we've seen in January, we do expect them to potentially rebound. So what our manager research is currently monitoring is whether the adjustments that they made will translate into sustained relative outperformance in the near future, and without them breaking their discipline necessarily. We will continue monitoring and come to you all with thoughts and recommendations. But the fact that they are making changes and reacting to the market itself is a positive. So no recommended changes at this time. The last manager we have on watch is the State of Vermont Stable Value Fund. This is a different story. This is actually a manager where performance has been in line with peers and the benchmark as we discussed before. So this is not a performance-driven decision. As you may recall, there has been senior level turnover in the past that we found a bit concerning. Before this most recent change, there has been 2 CIOs that departed in a more abrupt way over the last couple of years, and the head of their fixed income team also left last year. So to hear that there was additional turnover this year, where the 3rd CIO left and was replaced by someone from within the firm, and they hired another head of fixed income, is a bit of a bigger concern for us now. That being said, the biggest redeeming factor here is that Oliver Meng, who has been on that strategy for many years and has been co-leading the portfolio management of the responsibilities with Karen Chung, who recently left, is now at the helm of the strategy. He was acting head of fixed income for a while before they just hired the new head of fixed income. So he'll be focusing more on the strategy, hopefully, and will continue to provide continuity in terms of managing the strategy itself. But this instability is certainly a concern for us. The other redeeming factor is cash flows have not been out of line with other stable value managers in recent periods. There has been outflows from stable value in general across the industry, but they have been in line with peers and assets have been relatively stable. And then, of course, the third redeeming factor here is their performance being in line with peers. So staff and RVK are going to continue talking to them about this very most recent change, but we will also continue to evaluate potential paths forward. There are a lot of strong stable value managers out there, and we help clients every day make replacements in that space. The fact that they have had strong performance means that we don't need to make any fast, quick decisions to terminate. And within stable value funds in particular, the unwind process certainly takes a bit more time. It typically involves a period of 6 to 12 months to terminate, which shouldn't be an issue here, as I mentioned. So what we are doing is we're gonna look at the strategy again, talk to them again, and maybe collect our thoughts and get back to you all with maybe some more thoughts and feedback over the next quarter. But like I said, we don't see any reason to act right away. But we are not happy to see changes like this at this significant frequent rate. All right. I think this really is all we had on the watch list update. So overall, we're recommending keeping all 3 of them on the watch list at this time. 2 for performance, 1 for performance-driven reasons, and then 2 of them for organizational team changes. No immediate action is requested from you all today, but as we've done in the past, we'll come to you with any changes or updates we have from the managers and thoughts on next steps.
Derek, could I ask one quick question on the last, the new addition of the watch list? Obviously, I think in the outset, you had mentioned that the news we found out relatively soon, earlier this month. I appreciate you flagging this first. Have we been able, do we have insight into, obviously people make decisions for all sorts of reasons. Do we have any insight to what's going on at the firm as they're planning to have those conversations? Just curious sort of about what keeping this type of issue on watch, what does that look like? How do we sort of figure out what's underlying the changes?
So there are what the managers typically don't share or haven't unfortunately shared a lot of color on what drove those individuals to leave. But I think our manager research team has reasons to think that there are two underlying factors there. The first one is Mission Square as a firm is seeing a lot of client outflows since 2018, and they have been losing a lot of business. And there is a sense that they are not investing as much in their investment arm, and there's a lot of it's just higher level organizational instability there that could be impacting their investments as well. This is a bit offset by the fact that stable value in particular is their biggest fixed income strategy. So if they are going to dedicate any resource, it's likely going to be to this particular asset class. But that turnover cash flows creates a lot of uncertainty within teams. And then the other thing that we see with managers is that over time, Mission Square, this is a sub-advised strategy. So managers within the strategy that I mentioned, the head of fixed income and Oliver, etc., they are not managing the underlying set parts of the portfolio. They are delegating that. This is fully delegated externally. And so a lot of managers may find it more potentially worthwhile to work at other firms where the firm itself or the investment team itself will have more control on the structure and the decisions made within the portfolio. And even in more recent periods, I think they have moved further away from a structure where like they used to have an internally managed sleeve within the portfolio that they just removed late last year. So our research team feels that this could have been part of the reason why there has been more turnover within the investment team, is they just don't feel that as fulfilled managing the strategy without any internally managed assets. So that's a bit into the weeds on what's happening there. But again, Oliver continues to be managing the strategy the exact same way it was managed historically. We're not seeing any performance impact. So while we currently don't feel there are a lot of better ideas in that space, we think we have time to evaluate options and come back to you with a thoughtful, more rounded review. That also gives our research team more time to digest those changes and have more discussions with Mission Square, since this was just revealed to us 2 weeks ago, and we just had one meeting with them since then.
Thank you. I appreciate the extra color on that. Thanks.
All right, I know we have some time to make. So in summary, no changes to the watch list this quarter. All 3 managers have been on watch that we recommended to be placed on watch in November. We continue to recommend keeping all 3 of them on watch this quarter. And nothing else to report. Tim, anything else you wanted to mention here on the watch list?
No, I think this is working well. This is sort of what I think I had hoped for with as we implemented this new practice, and so very pleased with the report.
Thank you, Tim. So that concludes the 457 plan governance agenda item for us. The next item we have is the 457 plan fee change decision discussion. So
Sarah, can you
Oh.
hold off a second? I think I saw a question.
Oh, sorry. Hi,
I'm
Beth.
so sorry.
Thank you.
I was into some of the other documents provided, and I see that the Columbia Acorn International Fund you have on the watch list and a recommendation for formal search process to identify potential replacement.
So yeah, so that
It's in a different.
That's not in this. That's not in this plan.
Yeah, but sorry. So then I may be reading the wrong set of materials, but it was in the package.
if
I might have to connect with
Yeah.
you offline about which package you're looking at, or I'll square away with Bill. And it's
Yeah,
I missing
hopefully
something?
it shouldn't
it's a
be in
2026-02 watch list slides final. So it's watch list slides. I'm happy to follow up after. I just noted
Yeah.
it was included.
Oh, yeah. So apologies on that. We included some working documents that we had. The larger deck is the final one that applies to this. I think we inadvertently included a couple working documents. One of those had all of the funds that were on watch list for all of our funds. So that's in a different plan, and so we'll deal with that with another board. It's not in this one. Sorry about that confusion.
No, not at all. Thank you.
Oh, no, and thank you, Beth, for flagging. Sorry about that. Yeah, we have internal documents where we discuss with staff all the managers across plans. So that sounds to be the one you mentioned. So all right. So
We
the
would certainly
next...
have flagged that one.
Yeah, this one is certainly a different story.
Yep.
So all right.
So,
So
Sarah,
our next...
I might just tee up the fee
Sure.
analysis conversation,
Of course.
if that's okay, Mr. Chair.
Yeah.
Great.
Please, Tim.
So
Thank you.
yeah, so we've been talking about this issue now for a few times, and what we're hoping to do at this meeting, having had discussions, having had an opportunity to talk with Empower, we are hoping to land at a decision today to be effective July 1. When we say effective July 1, we mean for service after July 1, not for bills that we receive on July 1. So starting, for anyone in the plan as of July 1, our recommendation based on everything we heard from the board and sort of our own view would be to adopt an annual fee of 0.055% with a $24 per participant charge, paired with a full fee waiver for plan balances under $5,000. We think that does a couple things. One, it matches because our costs as charged by Empower have that $24 per participant fee and an asset fee. It mitigates any risk of misalignment if, say, you have a really down market. If we were to put everything in an asset fee, it may be that the amount charged isn't enough to cover our costs to Empower. So we thought aligning the per participant fee made sense. Of course, where that can have a negative impact is particularly those low balances. So after we had talked with the board about, I think we initially talked about a $1,000 fee waiver and got the sense that maybe we should think about a little higher. We refined our thinking to the $5,000 amount. So we think that both kind of balances the need for us to have sufficient funds available to pay the bill. As we had talked about before, create a modest annual surplus that we could reinvest in the event that it grows too much and it's misaligned. We could reinvest in a fee holiday. But this is where we landed as based after all our conversations. So wanted to bring it back to you with those scenarios we had presented before so folks could see them. Let us know what you think. But we are hoping to nail this down because we would like to turn into the communications and implementation phase so that we could achieve that July 1 date.
And thanks for that overview. And, you know, I just want to also say before we get into discussion, I appreciate really the work that went into this in prior meetings to sort of bring this concept and get feedback and go back and refine it. And then, you know, now this is our third crack at it, I believe, you know, to have a recommendation before us that, you know, we can discuss today. So I just appreciate the process that went into kind of providing the background for this decision. I'd love to know, I'd love to hear Better's thoughts on this. I just have one question really. I'll just hold that for the moment and see if anyone else has comments on the materials before us. I do really like sort of the hybrid structure, Tim. I think you pointed out some of the why that makes a lot of sense. And it's something this board has talked about previously, but I love to hear others' thoughts as we look at, you know, how this has evolved to this point.
Yeah, and maybe I can summarize them very, very briefly. So, so as Tim mentioned, the first scenario we have here, these are the three finalists we landed on after all the discussions last couple of quarters. This is the one that aligns the most with the record-keeping structure of 3.5 basis points and $24, basically passing on that $24, eliminating and 3.5 basis points, eliminating the risk of any mismatch. And to make sure low balance folks are incentivized to stay in the program, there is also that fee waiver of $5,000 here. And it also, this one, and as well as the other two, all of them will make sure that we have a small buffer of 35 to 45,000 of additional surplus. So that's about 50 to 60% of the annual admin cost of the plan. And the goal here is that this surplus can then be applied towards a periodic fee holiday, but maintaining that surplus makes sure that the plan doesn't need to make frequent changes to fees if and when there is a temporary situation where cost exceeds revenues. So scenario one, we really like it because it's most aligned, but it's also very simple to implement because Empower is already assessing those fees on those accounts on a quarterly basis. So instead of billing the $24, they're just gonna deduct them from participant accounts. So from an admin standpoint, it's also much easier to implement that way. But the two other finalists before you here are also ones we discussed. The second one has a same fee waiver, but instead of passing on that full $24, it passes on just $12 and charges a slightly higher asset-based fee. So that lowers the cost even further on some of those lower balance accounts, but it will create a mismatch with the cost structure from Empower. And then the third one, that's a pure asset-based fee with a fee cap of $300 on the higher balance accounts. This would have the lowest fee impact for those the lowest balance individuals, but at the same time, it would create the biggest mismatch, of course, with Empower's current fees, since those balances tend to fluctuate more than participants. It will increases the likelihood that there will be periods where the two are not aligned, and increases the risk of a need to change the fees down the road potentially. So, which is why we're recommending that first alternative here. Like Tim summarized very well, we do feel it achieves the board and our goals of having a sustainable fee structure by being fully aligned with the record-keeping cost structure. But at the same time, what the waiver does is we think that it will help those starting on their saving journey. And in fact, sharing with participants that there will be a fee waiver, it will be something that we think will be well received by participants it's not easy to share communication about a fee increase. So when you pair that by saying, while doing that, we're also completely waiving all fees on balances below a certain level, I think will be appreciated. And this will create that equitable fee distribution as well. You see higher balance participants are contributing more on an absolute dollar level, but they are paying a slightly lower effective rate in basis points. So, but they are certainly making a bigger contribution, and we think this is a fairer, a better overall allocation of fees across participants. And the surplus it creates is also in line with what we discussed before. It's a healthy one, about 2/3 of cost. It can be managed over time, by having those fee holidays very easily. A way to do so could potentially just waive the $24 for 1 quarter. That would use up about $40,000 to $50,000 in that quarter. So that's one easy way to do it if we don't see any actual increases in admin costs. And like I said earlier, it's very easy to implement for Empower because they're already assessing those $24 and the 3.5 basis points. So what they will do is they will just deduct the $24 from accounts instead of billing that plan. And then they will simply just increase the asset-based fee from 3.5 to 5.5 basis points. So I'll stop there.
Sarah, this is Gabe. First of all, I just want to say, everyone, I apologize. I do need to drop off here. Sarah, thank you, and staff, thank you for this assessment. The rest of the Empower team will be on, and we'll continue our conversations based on board direction. Thank you all. I apologize to run. Bye.
Thanks, Gabe.
Thanks for that.
So perhaps we should take it this way, because I think it would be best to have some of the discussion when a motion is made. But are there any questions on the presentation itself?
I have just one.
Okay, please, Jack.
Just to get a sense of the size of this fee, how does it compare in basis points to the investment management expenses?
I think that's going to depend largely on the fund, but do we have an aggregate, Sarah? I don't know that we have
I thought I was not on mute. We actually have not an aggregate per se, but we have this fee schedule summary across funds. And what we typically see in plans, of course, it varies depending on assets. This plan, I think their assets are somewhat split between active and passive, but what we see with plans is that, so these are the estimated annual fees across managers in total from the plan, whereas record-keeping fees will be still much lower than that. So typically, investment management fees are the biggest chunk of fees in any plan we work with, and then followed by record-keeping fees. They're about 517 total estimated for the next 12 months. Hope that helps. Compared to obviously we've been charging $280,000.
Thank you.
Other thoughts or feedback on these or the recommendation to us? I know Eric, you had some thoughts here. Oh,
I see Betsy has her hand raised too. Please, the floor is yours.
Hey, thank you. I'm probably trying to get at a similar question that Jay was raising, but maybe from a different angle, which is, when you think about our peers, obviously we need to do some kind of, plan administrator support. But is this consistent with peers nationally, or would this be a high or low fee structure?
yeah, great question, Beth. It is consistent with plans, peers. So so of course, so we need to caveat this by saying plans models are different. So you all have retirement planners from Empower that work with participants on a daily basis. Some of those plans don't have a robust education program. So it's not very apples to apples. But if you look at the blue diamond here, it is pretty much very close to the median across peers. And that is your current fee, the green one, and that is the so 7.7 is the proposed fee. So it brings you in line with peers, I would say, with the caveat that some of those fees do not reflect the suite of services that you're currently getting.
Thank you.
Of course.
My question was really on how we came to the recommendation based on the three paths laid out. But I thought that was covered by both Tim and Sarah's comments. So I don't see the need to ask that question that I was going to, and I'm prepared to move that we adopt the recommendation in our packet of an asset-based fee of 0.055% plus a flat $24 annual per participant charge.
I'm sorry to interrupt. Can I ask one quick question?
Sure.
That 0.055% fee, is that, I want to make sure I'm reading the graph that was ahead of this correctly. Is that a flat fee, or does that change based on where you fall in? Like based on your account amount?
Nick, we can work on this offline. I want to leave some space for the board to have a discussion right now, if that's okay.
Okay. Yep.
And we'll follow up with you after.
Okay.
Thank you.
I'd like to make a friendly amendment to the motion to include the waiver of all fees on balances under 5,000.
Right.
Yes.
With
Thank
that
you.
change, I'll second.
I appreciate that catch.
Sorry, could I make one more friendly recommendation? Sorry, not amendment, but just to make clear that it would take effect.
I'll restate my motion here for clarity. Please, though, Tim.
Oh, just if you could clarify the effective date. I'd like that to be very clear of July 1st.
Sure. I'd like to modify my motion to recommend to adopt an asset-based fee of 0.055% plus a flat $24 annual per participant charge with a full fee waiver for participants with balances below $5,000 to be effective July 1, 2026.
I'll second that motion.
Thank you, Jay. So with the second, the motion is on the floor. Any discussion on the motion? While my question on the presentation was answered, it's how we got to the recommendation. I was wondering how the alternatives between the $12 participant fee and the $24 per participant fee were were weighed, hearing that best aligns with,
What we're doing now.
$12 would sort of continue to mute the impact a little further on the smaller accounts. With the fee waiver, I don't think the amount is material. And with the fact that better aligns with the record keeping structure, thereby reducing potentially the need to make changes in the future, which I think is prudent to do all we can to avoid that. I was happy to support the recommendation. So I just wanted to give some color on. I was actually unsure. I wanted to just hear how those two alternatives were considered. And hearing that consideration, I was very happy to support the recommendation. Any further discussion?
I'll just say I like the balance of this combination of charges to cover the administrative expense.
We will keep you updated as we move through communications and implementation.
Thank you.
Thank you all for the feedback, and yeah, very, very helpful as usual. And yeah, we've already started working with Empower, to make sure that implementation of this can take place of any of the three alternatives, and that the timeline we're proposing here for you all makes sense, and that we can have this, in effect July 1st, hit the ground running. So we're gonna start working on communications now.
Thank you. Any additional discussion on the motion? Not seeing any. All those in favor of the motion on the floor, please signify with an aye.
Aye.
Aye. All those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it. And the recommendation before us is now formally approved by the board. Getting the next steps, I appreciate we just sort of touched on that. I had one question on, we're going to communicate this change, but given there's a fee waiver involved, how does that get communicated to participants? Does that, if there's a waiver and there's, is it assessed to accounts so they see it on the statement and then a waiver is also assessed? It just seems if there isn't some communication of what the fee would be without a waiver, when it becomes effective to those accounts, it might seem like a surprise. So I just wondered kind of the accounting of how that might happen. And maybe that's food for thought, but I just didn't know if there were thoughts on that.
Yeah, Mr. Chair, I think we might want to just talk about, have a further conversation with Empower. I know Sarah's already started that work, and maybe we can come back to you on that one, because I know we're already running a little bit behind.
Okay.
Excellent.
Given what we've discussed this, and yeah, well, more to come on that. It will be part of the assessment itself, so they will not assess fees on those lower balances. But more on that later. There was one update, Tim, that you wanted to highlight, or some the rough conversion question that was raised last time. Do we have time to mention that, or maybe next time?
I guess I'll defer to the chair. I think that was your question, Mr. Chair, from last time.
Yeah, I mean, I was conveying a question from a member. Let's hold that for other. I'll defer. I mean, I know we're a little behind schedule. Is this a quick update, or
I mean, I think the bottom line is yes, our plan allows it, and we haven't had uptake on it. So if that's sufficient, then
I think that is sufficient.
Okay.
Yeah, I appreciate the investigation. Thanks for getting that. I will pass that along to the participant who inquired. Thank you for looking into it.
Thank you.
Next up on
For
the
your time today.
agenda is the administrative budget. Oh, Sarah, thank you for your RBKs and your work. And participation in the agenda. There's a lot on there today. Thank you.
Thank you. Have a good day.
You as well. Next up on the agenda is the administrative budget for the system. Tim, I assume you'll lead us on this.
Yeah, that's great. And I'll try and move with some amount of pace. So I'll just share my screen quickly, try and make up some of the time here. So
Thank you.
this year, and we're not asking for a vote at this time, as I'll explain. So that's another reason. What I'd like to do is just kind of show you a new way that we thought of putting a budget together for the board's review of our administrative budget, and kind of talk about how it pairs with the ongoing review in the State House that first the administration, then the legislature undertakes. And ultimately, my goal is to try and make for a more understandable and usable budgetary presentation, sort of at an executive level, not kind of getting lost too much in the weeds. So that's the goal, and I hope that you'll let me know if we're getting near that, and then we'll come back later for a vote as later in the year. So historically, the image on the right is the form of the budget that is near and dear to all state agencies' hearts, that we use to present to the legislature, but that, at least in my lay opinion, is not it's not the most helpful, because it kind of puts as line items items that could be over $1 million or $1,000, and it sort of doesn't provide some of that overall perspective of what does it take to operate the enterprise. So what we would do is present this type of budget to you in the December-January timeframe, about the same time that we were presenting it to the administration and the legislature. And then, the legislature would work on it through the session, and a budget that may be the same as what we had presented before, or that may have changed, is approved in the legislature, and we never kind of came back to it at the board level. So for this year, what I'd like to do is provide that, as I said, in a more user-friendly executive level format, recognizing that work's still going on in the legislature, and ultimately I'd like everyone to understand both legislature and the boards and be on the same page about what our administrative costs are and what makes sense for the system. The board ultimately is the authority from expenditure from the funds, but we don't want to be at odds with what the legislature is approving either. So just want to have time in advance for you to see it, understand that it's still kind of pending through the legislature, and then we'll come back later, May, June timeframe. So this is the format that I'm planning on presenting it at. This is our combined system budget, meaning it's the costs for the retirement systems to administer all the plans that we administer. And the way I decided to break it out was, in 4 categories that I'll explain later. But what I like about this format, it's one that I stole from VPIC. So, Eric, you'll recognize it. I like how it kind of shows both, what's changing as a percent from last year, but also, how much it matters to the overall budget. Like, is it a big item or is it a small item? And I think that gives a better picture. So what's in each of these categories? When I'm referring to administrative costs, I'm talking about, all our staff salaries, everything internal, our office operations, like, equipment, insurances, fee for space, broke out communications and mailing, because that's kind of member focused. It's, what we spend to do our sort of necessary mailings or any additional communications to our members. And then staff and board education and support. And that's things like our memberships in national associations, trainings, travel, that kind of stuff. Agency support is pretty pretty basic. It's, we receive services from other agencies, DHR, ADS, the AG's office, auditors, and we receive our allocated amounts from finance and management, and that rolls through our budget like any other agency. We did bring out the medical review board. I decided to break that out as a separate item because it was kind of buried alongside of another line item that mixed in a health consultant we have for the teacher system. And again, I'm just trying to bring out sort of what these charges are in a more explicit way so folks can see what our expenses are. The third-party services, the ones you probably are most familiar with because we, we come to you or discuss our contractors with you. And so in the former budget, there would be a couple of these would be lumped in as technical. There weren't necessarily intuitive categories for where these contractors lived. And so we just wanted to break them out. And, we've got, our actuary is Siegel. We perform census audits for our teachers and muni systems. So you'll see that this is not a charge that applies to you. We have a health consultant in the teacher system, same thing. We have our death match service that we use to make sure that we're not paying pensions to people who've passed away and that we can find people when we need to. Legal, tech, and then VPAS is our big pension administration system that does maintenance and backup service. And now starting this is the first year it's actually in the budget. We started last year hosting, but it wasn't in the budget before that. Now it is in the budget. It's driving a substantial increase there. And then VPIC is just VPIC's budget pass through. So that's one that VPIC votes on and it's allocated to our systems. So that's sort of the format. And then VSERS, the VSERS specific budget, this is sort of the portion that we allocate. And you'll see this year what we're doing is we're allocating costs to the total cost between the pension and OPEB systems, because now that we're pre-funding OPEB, it makes sense to start directly attributing some administrative costs to that system because it does incur costs, and we have the statutory authority to, and I think it's appropriate. So that's the way we're formatting our budget this year. So you can see where the changes are, and the big cost drivers this year really are staff salaries and benefits. That's going to be a substantial increase. That is, all of the health insurance and STEP and COLA and all that stuff for staff, plus some small changes in allocations within the office. There is, our increase in comms and mailing is going up because we're working on plan guides for our members, and we're trying to basically do a little bit better job communicating with our members about what's happening with the systems, making sure that health insurance changes are communicated ahead of time. Actuary is going up a little bit because we have our experience studies, which we expect to be billed for in 27. It's about an extra, I think $30,000 to $35,000 for VSERS in this year's budget. And VPAS really is, as I said before, is the majority of that increase is the change to add hosting within the line item budget. So that's really what's driving that cost increase there. So that's sort of the budget as I wanted to present it in a nutshell. After this, I have a couple of additional slides that I think are interesting, but maybe I'll just take a breath and ask if anyone has any questions to this point.
Looks great.
Tim, I have one comment first. I do think this is much more understandable. I appreciate all the detail and the different ways to look at the impact on the budget. On VPAS, that it's a big number and it's a relatively large increase. Is that attributable mainly to maybe it wasn't a full year of cost last year, or did the solution actually increase annually by that amount?
So for VPAS, that's something that we did not have the hosting service in the budget. We in the 26 budget, we brought that recommendation to the board after the budget, once we realized that our on-prem solution was not going to be usable for long, and so we asked for authority to move forward there. So because it wasn't actually in the budget in 26, it's showing up for the first time in the budget in 27, that hosting piece.
Year over year, did the cost really increase by 23%, or is it an artifact of a full year being in the budget?
Well, the increase is from the budget year where it didn't have it to it's not the actual costs. It's the increase is the budget year to budget year.
Okay. So there were prior costs though.
Yeah, there's
Just
a lot of
not at that
maintenance costs.
Got it.
Yeah, maintenance. We have backup and continuity of operations testing that we do with VPAS. That the hosting is just a piece of it.
Got it.
I'm sorry
Thank you.
Apologies if you already said it, but where were the costs before?
We didn't pay them. We had a server in National Life, and
Gotcha.
that server hosted our solution, our administration system. That manner of operating is no longer best practice, and pretty much most entities are migrating to the cloud. So because we had reached end of life and our IT director told us, we have to do something. We are now in a model where we're paying effectively a subscription for the hosting service.
All right, so it was a legacy system that had reached its end of life.
Yes.
Okay, thank you.
Yeah. So I'll move forward with
I
this.
see Beth F
sorry.
has her hand raised.
Yeah, I just wanted to add in, and I'm not sure if this is true, so Tim can probably confirm, but ostensibly then you would be paying less to ADS for playing that hosting, for hosting those services. I'm not theoretically, because we don't have to pay for the server there. You would have to pay, right? So that's the net, right?
Whether it's ADS or to us, because we
Okay.
have some internal IT staff.
Okay,
But we didn't have like an ongoing, because it was a physical, it was a capital asset we had, right? These servers, we weren't paying that monthly charge. It was sort of
got it.
buried in staff time, the maintenance of that. Yeah,
Thanks.
sure. I wanted to just share this because I find it interesting. I look at it every year. A few years ago, we stopped having a separate appropriation for our administrative budget, and we rolled it into the ADEC. So we now have an assumption of what 0.45% projected payroll, that's going to be our administrative cost for the year. And like any assumption, we then have experience. So these numbers aren't going to match up exactly because I think it's a different form of accounting that we're using for the budget versus our financials. But they're similar, and they're what they show that I think is interesting is, for VSERS, sort of what that in the past couple of years, at least, we've had a slight gain in this space of, about $350,000. So I just thought that was another interesting way to look at the budget and provide some color. And then the last thing I wanted to provide is, we do a lot of things in these systems that don't show up in our budget. So all of the Empower costs, they're paid for by our members. But, it occurred to me as I was putting this together, gosh, we spend all this time doing this and working on the contract, but it shows up nowhere in the budget. So we just put together these, for partners where they don't show up in our administrative budget, but they roll through or are paid from different sources. We just wanted to show a rough approximation, and we're still refining our methodology here for Empower. As we just discussed, a lot of the fee is asset-based. I don't know what the assets are going to be next year. All we're doing is projecting, rolling forward recent history, appreciation to come up with something that's kind of indicative to give you a rough sense of what we're paying. this year and next year. I don't know if this is the best way to do it, but I wanted to at least acknowledge these expenses as we present this to you, to try and give a better picture. So for example, like Delta Dental is similar. That's the premiums, and the state doesn't pay any. It's all our members. And we know that that's going to go up about 7%. So because we know that increase, that's what we increased it by. We also know the increases for, our teacher health insurance. We don't have the similar expense for state health insurance because that's all managed through DHR. So it's not something that is a cost that we manage as directly. So that's why I put these all in for all the systems, identified which system it applies to, and yeah, just thought it was interesting. So, going forward, again, not looking for any action today. We're going to monitor the budget as it moves through the legislature. And my expectation is to come back to you in the spring. Numbers may change because maybe we'll have been approved the position we're seeking. So that would be added to the budget. But then we'll ask for a motion of approval at that time. But I didn't, like most things, when I'm asking for an approval, I try not to hit you cold as if I can avoid it, and give you an opportunity to see what's coming. So this is what's coming.
Thank you, Tim. I appreciate the thoughtful thinking about the process and, how the timing, looking at it after, some of the changes to the budget might be finalized makes, I think, always looking at our processes and how that plays out is good. I appreciate your thought on that. And I think it is very much understandable. So thank you for conveying it to us in this way. Any additional questions on this agenda item?
I guess I'll say I've been very comfortable with the old format, that first layout of how you show the budget. I've been working with that for a long time, and it's very familiar, but slicing it the way that you have for your proposed new approach, I think gives us an easier to look at picture, and steers us away from the weeds and more at where the big cost drivers really are. So thank you.
Pleasure.
Looks great.
Thank you, Jay. So I think that takes us to the next item on the agenda, which is the legislative update. Tim, how do you want to handle that?
Well, just doing a quick count. Do we? Yeah, we still have a quorum.
Well, are good.
Okay, yeah, we're good. So, quick legislative update. I'll be very brief. Our as of now, our 8X are in the budget, so that's very good. Our omnibus treasurer's bill, that's H567. That has come out of House Gov Ops with unanimous vote and support. So that's the bill that has the funding task force, the transition of the OPEB investments, the extra position that we were looking for. It was a very successful appearance in House Gov Ops. All the stakeholders were in support, so it was good. It's in Ways and Means now, and we expect them to vote it out next week and over to approbes after. Just wanted to flag today and tomorrow I'll be in the legislature testifying on a couple of bills that have come up. S295 seeks to make a substantial addition to Group G, looking to add all classified employees of DCF and a number of other smaller categories. It would effectively double the size of Group G. And make a couple changes to another change to Group G, where I'm actually not 100% sure what it does yet. And there's something on accidental disability. So we are going to testify. I think generally speaking, the position is going to be where anytime we're considering benefit changes, we should probably take a minute and assess costs understand what this is going to do and how it's going to affect our funding schedule. Commissioner Fastigia, I've been in touch with some of your folks over there and was going to also recommend that they maybe reach out to you or your team in the event that you had any comments on that bill. So that is in Senate Gov Ops later today. And then tomorrow, there's not a bill number attached to it, but there is a proposal to include police trainers in Group C. That one, I don't know if some folks will remember a few years back, we did the Law Enforcement Retirement Benefits Study Committee, affectionately known as the LERBC. That committee looked at a number of positions, these included, and flagged them as potentially problematic for inclusion in Group C because Group C has a mandatory retirement age, and you can only apply that to law enforcement. And sort of the position descriptions pertaining to the trainers were such that they did not seem to meet that definition. So we have a report. We're gonna, I'll kind of dust that off and bring it to the committee to remind them of that work that we've done in the past. So I think we'll just want to kind of flag those concerns for their information. So those are the, David, if there's anything else, I think that's pretty much what we have on our plate right now in the legislature. Obviously, we're continuing to monitor and make sure everything ends up where we hope it does.
Thank you, Tim. Any questions on the legislative update? Not seeing any. I think that brings us to the last item on our agenda, which is any other business to come before the board. I was going to follow up on the Roth conversion, but no need. Any other items to bring to the table this month? Was a full agenda this morning, so I appreciate everyone's time. I'm not seeing any other business, so
Eric, I move we adjourn.
Thank you, Jay. Is there a second to Jay's motion?
Second.
Thank you. I see Beth F. seconding. Motion to adjourn is not debatable. So all those in favor, please signify with an aye.
Aye.
Aye. All those opposed with a nay. The ayes appear to have it. The ayes do have it. And the February meeting of the Vermont State Employees Retirement System is now adjourned. Thank you all for your time today. We took care of a lot of business.
Pleasure working with you all, and then enjoy the beautiful Vermont winter day. It's really gorgeous out there.
Nice. It's nice. It's not so cold, but we have the snow.